Most traders buy exactly where smart money is preparing to sell. They see price flying up, they jump in late, and seconds later, boom, price reverses. Why? Because they bought in premium. They bought when price was expensive. Today, I will show you a simple strategy that helps you avoid that mistake. We are going to use the Fibonacci retracement tool, the 50% equilibrium level, discount and premium zones, liquidity grabs, change of character, and a simple entry model to find cleaner trading opportunities. As always, this video is for educational purposes only. This is not financial advice. Trading involves risk, so always manage your risk properly. Now let's get straight to the point. The discount and premium strategy is very simple. In a bullish market, we want to buy from discount. In a bearish market, we want to sell from premium. That is the whole idea. But to know where discount and premium are, we use the Fibonacci retracement tool. The Fibonacci retracement tool helps us measure a price move. For this strategy, we mainly care about the 50% level. This 50% level is called equilibrium. Equilibrium means the middle of the move. Above the 50% level is premium. Below the 50% level is discount. So in a bullish market, price above equilibrium is expensive. Price below equilibrium is cheaper. And as traders, we do not want to chase price when it is expensive. We want to wait for price to come back into discount, where the entry is safer, the stop loss is cleaner, and the risk to reward is much better. For this example, we will use a bullish market, but the same idea works for a bearish market too. The market is creating higher highs and higher lows. Once we identify that bullish move, we take the Fibonacci retracement tool and draw it from the swing low to the swing high. The swing low is the start of the move. The swing high is the end of the move. After we draw the fib, we mark the 50% equilibrium level. Everything above 50% is premium. Everything below 50% is discount. Now, here is the mistake most beginners make. They see price in premium, they see a small reaction, maybe even a change of character, and they immediately think the market is reversing. But in a bullish market, a change of character inside premium is often just a liquidity grab. It can be a trap. The market grabs early sellers, pulls liquidity, and then continues higher. So we do not rush. We wait. We want price to come into discount. Once price reaches the discount zone, we still do not buy immediately, because touching discount is not enough. We need confirmation. Inside the discount zone, we wait for two things. First, a liquidity grab. Second, a change of character. A liquidity grab happens when price sweeps a short-term low. It goes below the low, triggers stop losses, collects liquidity, and then rejects. This is where many traders panic. They think the market is going bearish. But if this happens inside the discount zone of a bullish market, we start paying attention. After the liquidity grab, we wait for the change of character. That means price breaks a short-term high. This break tells us that the pullback may be ending and buyers may be taking control again. So the setup is simple. Bullish market. Price enters discount. Price grabs liquidity. Price creates a change of character. Then we look for the entry. But we do not chase the candle. We go to the lower time frame. The higher time frame gives us the direction. The lower time frame gives us the entry. For example, if we are using the 1-hour chart to find the discount zone, we can go down to the 5-minute or 15-minute chart to refine our entry. On the lower time frame, we use the Fibonacci retracement tool again. This time, we draw the fib on the bullish move that created the change of character. We draw it from the low of that move to the high of that move. Again, we focus on the 50% equilibrium level. That 50% level becomes our entry area. Why? Because instead of buying at the top after the change of character, we wait for price to pull back into a fair price. We let the market come to us. This keeps us from entering emotionally. The stop loss can go below the liquidity grab low or below the recent swing low. The target can be the previous high, the next liquidity area, or the next higher time frame objective. Now here is the golden point. How do we know if the correction will be small or deep? We observe the strength of the market. If the market is strongly trending, the pullback is usually small. That means buyers are aggressive. Every dip gets bought quickly. In a strong trend, price may not give you a deep discount. It may only pull back slightly before continuing higher. But if the market is weak, slow, or losing momentum, the pullback can be much deeper. That means buyers are not as aggressive. So remember this: strong trending market equals small pullback. Weak trending market equals deep pullback. This is important because many traders wait for a perfect deep entry in a strong trend, but price never comes back. And other traders buy too early in a weak trend, then price keeps pulling deeper. So do not just look at the fib. Look at the behavior of price. Now let's talk about trade management. Once we are in the trade and price starts moving in our favor, we can use a simple trailing technique. Every time price creates a new break of structure to the upside, we can move our stop loss below the recent swing low. This allows us to protect the trade while still giving price room to move. Think of it like climbing stairs. Price breaks a high. Then it forms a higher low. Then it breaks another high. Then it forms another higher low. Each time the market confirms a new structure, we can use the recent swing low to protect the trade. This way, we are not managing the trade with fear. We are managing it with structure. Now let's quickly recap the full strategy. Step 1, identify a bullish market. Step 2, draw the fib from the swing low to the swing high. Step 3, mark the 50% equilibrium. Step 4, wait for price to enter discount. Step 5, wait for a liquidity grab. Step 6, wait for a change of character. Step 7, go to the lower time frame. Step 8, draw the fib on the move that created the change of character. Step 9, look for entry around the lower time frame 50% equilibrium. Step 10, place your stop below the liquidity grab or recent swing low. Step 11, manage the trade by trailing your stop below new swing lows after every break of structure. And that is the discount and premium strategy. The idea is simple. Stop paying full price for a trade. Let the market come back into your zone, wait for liquidity to get taken, wait for structure to confirm, and then execute with patience. Because in trading, the best entries usually do not come from chasing. They come from waiting. If this video helped you, make sure to like, subscribe, and turn on the bell so you never miss the next lesson. Thank you for watching, and I will see you in the next one.